This is Quint Bilo with a discussion of certain topics, investments. We'll see why corporations make certain investments, explain some accounting entries, and look at how the results are reported in financial statements. In this first talk, I'll focus on debt investments, coming back to stock investments later. Be alert as to how the time frame of how long investments are intended to be held can affect our accounting treatment. So why corporations invest? We'll focus on debt investments, and we'll get into some reporting of these investments. There are many similar reporting issues for bond and certain stock investments, so we may see both bond and stock investments in the same examples. Corporations generally invest in debt or stock securities for one of three reasons. They have excess cash, they want to generate earnings from investment income. In other words, idle cash in the bank isn't earning any money, so they put it in some temporary investments, or for strategic reasons, control a supplier, expand operations. Item 3 would generally refer to buying stock securities. If temporary investments are used, they're bought and sold, some very frequently, before the money is needed for other purposes. So for temporary investments, we're looking at how corporations record their entries to buy and sell temporary investments before they needed to buy inventory, which is used to make sales, turn into receivables, back into cash again. An important part of this chapter is how the corporation reports the investment. It'll depend upon what the corporation's intentions are for that investment, mainly how long it intends to keep it. For example, if an equity or stock investment is made for purposes to control the other corporation for strategic reasons, how much control is exercised depends on the percent of stock ownership. The accounting treatments will vary based on this percent of ownership of the investment. But we'll look at stock investments later. Two types of investments, debt investments and equity investments. Debt investments, we're buying the bonds of another company, loaning them money to obtain interest payments. Equity investments, buying the stock of another company for dividend income or perhaps control purposes. Each, as I mentioned, has its own type of accounting treatments. Debt investments are much simpler of the two, and that's where we'll start. Recording the acquisition of bonds. Now, this chapter is taking a completely reverse view of bond accounting that we've seen in the previous chapter. Stay alert to this. We're not issuing bonds, we're buying them. The previous chapter involved the corporation issuing or selling the bonds, in other words, obtaining desired cash through borrowing. Here we have excess cash, and the corporation is looking at buying the bond of another company to obtain interest income. So we're putting on a completely different accounting hat. It's much simpler. It's from the investor perspective, the buyer of the bonds. Our accounting concern for the buyer of bonds is really much simpler than issuing them. So don't complicate this first investment. So in accounting for debt investments, we first have to record the acquisition of bonds, their purchase. That'll include the cost plus any brokerage fees that are involved. Secondly, we record bond interest that's earned by us as the bondholder. And finally, we'll record the sale of bonds getting out of the investment. We'll credit the investment account for the cost of bonds and record any gain or loss as appropriate. Let's take our first bond example. Cruel Corporation acquires 50 Doan Inc. 8% 10-year $1,000 bonds on January 1st for $50,000, including a brokerage fee of $1,000. Let's record this entry. January 1, asset cost, debt investments are debited, $50,000. Note that the selling price of the bonds was $49,000 plus we had a $1,000 brokerage fee. Credit cash, $50,000. Took excess cash and put it in a temporary investment. As noted, we know the selling price was $49,000 because the total cost of $50,000 included a brokerage fee. The key, though, is that the base amount of bonds are $1,000, 50 bonds, total of $50,000 face value was purchased. Let's record the first semi-annual receipt of bond interest from Doane Corporation. July 1, we're 6 months down the road after we bought it. We're going to debit cash $2,000. Again, the payment of interest on bonds, as we learned in the last chapter, is always a fixed amount. It's based on the face value, not necessarily the selling price, times the 8% coupon rate. In this case, 1/2 of a year, 6 months, $2,000. Credit interest revenue, $2,000. Now, let's fast forward 6 months to the end of the year. The last time we received interest was on July 1. The next payment is due on January 1. However, at December 31st, we have a reporting period for our company. So we need to record the accrual of interest that we earned for the last 6 months. Debit interest receivable, $2,000, increases that asset account. Credit interest revenue, $2,000, will appear in our income statement. Again, we're not receiving interest, we're just accruing it for the last 6 months since we received it, and we're doing it because we're reporting our balance sheets at December 31st. We need to update our financial condition. Now, 1 day later, when that interest is paid to us by Doane, we'll debit cash $2,000, increasing it, and bring down our receivables, interest receivable with a credit, simply swapping assets. Next example. Assume that Cool receives net proceeds of $54,000 on the sale of the bonds. Okay, so we had the investment for a period of time, got some interest from it, now we're going to sell it. Let's prepare the entry to record the sale of bonds. We're getting $54,000 cash for this. Bond selling prices, by the way, can fluctuate on a daily basis. What do we pay for them? We only paid $50,000, so we'll credit debt investments, decreasing our investment. We're out of that investment. The difference, gain on sale of investments. That's our income statement effect, $4,000. It's a very straightforward entry. We book what we got upon its sale. We took out its original cost to us and booked the difference as a gain on sale. Review question. An event related to an investment in debt securities that does not require a journal entry is a change in the name of the firm issuing the debt. Everything else, the acquisition of it, receipt of interest, or the sale of debt investment requires a journal entry on the part of the company making this temporary investment. Another question. When bonds are sold, the gain or loss on sale is the difference between what? Note at the bottom, if there's any fees to sell the bond, they would reduce the sales price. It would be our net proceeds. So our gain or loss is based on the net proceeds from the sale and the cost of the bonds. Again, net proceeds are the sale price less any commissions we incur to sell those bonds. The reporting of debt investments on the balance sheet, I want to make a point of emphasis here. The accounting entries for bond investments that we just went through are very straightforward. We'll probably spend more time now showing how these are reported on the balance sheet. So bond investments can be held for a very short period of time. The investment would be in our current asset section. We could hold our bond investments for a somewhat longer period of time. It still could be a current asset, or it might be a long-term asset, depending on how long we expect to hold it. Or we may hold the bonds until they mature, in which case we definitely classify the investment as a long-term investment. There are generic technical names associated to these intended time periods, which we'll look at right now. So companies classify debt and stock investments, by the way, into 3 technical categories: trading securities, available for sale securities, and held to maturity securities. Trading securities are the shortest time frame for holding them. We could buy them 1 week and sell them the next. Available for sale securities, somewhat longer. We don't know how long we're going to hang on to them. Held to maturity, the longest time frame. So the time of expected holding of the investment will affect our accounting. Let's look at trading securities first. Companies hold trading securities with the intention of selling them in a short period. That could be daily, weekly, the next month. Trading means frequent buying and selling. Companies report trading securities at fair value and report changes from cost as part of net income. Now, market value is another term for fair value. And as value rises while we hold on to these, any gain or loss is reported in the income statement. Any changes from original cost, we'll call those fluctuations in value, which we'll record periodically. Question: marketable securities bought and held primarily for sale in the near term would be classified as trading securities. In other words, we expect to buy and sell these quite frequently. These investments, as we buy them, will be included in the current assets section of the balance sheet, because current assets are expected not to be held for more than 12 months, and will value any fluctuations. Any fluctuations in their value will be reported in the income statement, which ends up in the retained earnings account when we report a balance sheet. Let's take a look at how the change in investment value is recorded. We'll be making a journal entry to record a change in the value for the investments held by Pace Company. They have two investments, one a bond purchase from Yorkville Company, and another is a stock investment in Kodak Company. Now, both bonds and stocks can be classified as trading securities, which, as we know now, just means that they are held only for the short term. They can be sold any day. So, our previous purchase cost for both of these securities was $140,000. Now we are at December 31st, a reporting period for our company, and we need to update the value of these investments in our financial statements. At December 31st, we determined the fair value, or current market value, is $147,000. That is $7,000 higher than what's on our books right now. We'll make just one entry to recover the change in value for both of these investments. So, we want to increase our asset values. We will debit an asset account for this purpose. We'll use a new account called Fair Value Adjustments. Debit it for $7,000. This new account modifies the original cost of our investments presently on the books. They're just added together before we pull off the balance sheet. If our asset value increases, we explain why in an account on the other side of the equation. In this case, unrealized gain income. The fluctuations in value for a trading security classified investment will go straight to our income statement. That's why the gain account includes the word income. Fluctuations in value for trading securities are reported in the income statement. Now, I'd like you to associate the trading security classification with the income statement. The gain recorded is unrealized, meaning the investments haven't been sold yet, but their market values have changed, and we are required to reflect that change in our books. Credits are favorable for the income statement, and so they report an increase in that statement. Now, let's look at how the total new value of $147,000 is reported. This is a combination of the original cost previously on our books plus the fair value adjustment we recorded in the entry below. On our balance sheet, you mean our current asset section, we call it short-term investments, $147,000. One number for both the investments. No need to show detail here. This is the current value of these two investments. Why is it in current assets? Because management intends to sell these investments somewhat quickly, certainly within 12 months, perhaps earlier. Hence the current asset classification in the balance sheet. And any income effect for the fair value adjustments that we showed previously show up in the income statement itself. Let's look at another classification, available for sale securities. Companies hold securities with the intent of selling these investments sometime in the future. Indeterminate. They don't know how long they're going to hold on to them. These securities could be classified as current assets, or they could be classified as long-term assets, depending upon the intent of management. How long will they be held? Now, companies are required to report these securities also at fair value and report changes in cost, that is, fluctuations in value, as a new component line of the stockholders' equity section, not in the income statement. This is a change in reporting, again, just for available for sale securities. Remember, market value is another term for fair value, changes from original cost. Now, how would our journal entries change if the securities that we have invested are classified as available for sale? Available for sale, as we know now, means that we're going to hold it for a longer term, indeterminate. We don't know how long. Now, the entries will be the same, except that the modifier on the unrealized gain or loss account will be slightly different. For available for sale securities, we cannot put the unrealized gain or loss in the income statement. So we use an account called unrealized gain or loss dash equity and not use the one with a modifier of income. The unrealized loss, if there is one, would be deducted from a new stockholders' equity section rather than charged to the income statement. Likewise, if we had an unrealized gain, it would be added to this new section. Unrealized gains appears as a credit on this line. Unrealized losses appears as a debit. Let's take a look at an example. Assume that Albert Corporation had two securities that it classifies as available for sale. That is, we don't expect to sell them in the near term, not next month, but we're going to hold it longer. It's indefinite. So, again, we can have both bonds and stocks in our available for sale securities classification. Our original cost when we bought them is $293,537. We purchased them previously, date unspecified, but we're at year end, December 31st, a reporting period for us, and we need to report the fair value. Reporting of fair value is required by accounting rules. So the fair value for these securities is $284,000 compared to $293,537. Therefore, it's lower than, it's less. We have a loss here, an unrealized loss. Again, we're not selling these things, but the value has decreased. We need to reflect that in the journal entry below. So the adjusting entry for Albert Corporation at December 31st, I'm going to bring this fair value adjustment in here. I'm going to credit it now. This is an asset account, a modifying asset account. Assets go down with credits. So the value goes down by $9,537. And the other side of the entry, unrealized gain or loss dash equity. In this case, it's a loss because it's a debit. Now, because these are available for sale securities, held for a longer term, we can't bring that unrealized loss into the income statement. That's why we use the equity modifier on this account. So again, I want you to associate available for sale with the unrealized gain or loss equity account. Cannot flow through the income statement. How are we going to report the $284,000 value on our balance sheet? We can't put it in short-term investments because that implies that we're going to sell these within 12 months. We don't know that. So therefore, it has to be classified as a long-term investment. Again, one number for whatever investments we have in that category. If the intent is to hold these investments more than 12 months, they need to be classified as long-term investments, not current assets. The intention of management in terms of this classification is key. Review question. An unrealized loss on available for sale securities, where is it reported? It's reported as a separate component of stockholders' equity. It cannot go through the income statement. It cannot end up in retained earnings at the end of a reporting period. As noted, we're actually going to create a separate section on the balance sheet for this unrealized gain or loss. To review, an available for sale classified investment just means it's not intended to be sold quickly. We don't expect it to be sold within 12 months. So we can't put this investment asset under current assets in our classified balance sheet. Further, any adjustment, debit or credit, to its fair value cannot go into the income statement. We have to hang it up into a separate line in stockholders' equity section, which we'll look at shortly. Short-term investments are also called marketable securities. These are securities held by a company that are readily marketable and are intended to be converted into cash within the next year or operating cycle, whichever is longer. If an investment criteria does not meet both these criteria, it must be classified as a long-term investment, not as a short-term investment. And we learned that trading securities are always classified as short-term and current assets. Available for sale securities can be short-term or long-term based on the intent of management, how long they're going to hold it. Let's talk further about realized and unrealized gains or losses. The gain or loss is realized when we've sold the securities and obtain a price more or less than our current value on the books. An unrealized gain or loss is we still got them, but we're at a reporting period and has the value gone up or down based on the last time that we reported them on our financial statements. Now, actual gain on the sale of investments or actual loss on sale of investments always go through the income statement in a non-operating section of the income statement. Any unrealized gains or unrealized losses that could go through the income statement, if they're trading securities, will also go in the same non-operating section. Non-operating means the activity can't be counted on to be repetitive each reporting period, therefore it's shown lower in the income statement. Again, as I noted, any unrealized gains or losses that are reported in the income statement can only be there if the investment itself is classified as a trading security, in other words, really short term. Now, if we're just concerned about unrealized gains or losses on available for sale securities, those held for longer periods of time, I want to show you what the separate line in the equity section would look like. It simply be an addition below the retained earnings. In this case here, unrealized loss on available for sale securities, $100,000. This can be thought of as a buffer account. It keeps any value changes out of the income statement until sold. If we had a trading security that had an unrealized gain or loss, it'd be reflected in our income statement, which is closed into the retained earnings account for reporting purposes. But for an available for sale, it must be isolated separately. It can't go into the income statement. It's put on the balance sheet. Let's review these one at a time. Let's look at realized gains or losses. That is, we've sold the asset, and so that the asset value, we obtained more or less cash than what was on our balance sheet. So assets go up for what we sold it for. We take off the cost of the asset when it's sold, and the realized gain or loss is reported in the equity section of the balance sheet in the income statement, and therefore closed into retained earnings. Now, if it's an unrealized gain or loss, we haven't sold the investment. We're still holding on to it. However, the value has changed at the time of the reporting period. So any unrealized gain or loss, again, we take care of the asset values either up or down using a fair value adjustment asset account. But on the right-hand side of our accounting equation, in the equity section, it only goes through net income if the investment was classified as a current asset. If the asset was unsold, but the investment was classified as available for sale, meaning we're not sure when we're going to sell it, any holding gains or losses unrealized cannot be placed in the income statement. It goes in its own equity section below retained earnings on the balance sheet. Cannot flow it through the income statement. The asset up or down works the same way for both current assets or available for sale investments. It's the reporting of the unrealized gain or loss which makes a difference as to how long the asset is held. Again, showing this new separate component of stockholders' equity. This would show unrealized gains or losses over time for available for sale securities. We can't flow it through net income and retained earnings. It has to be shown separately on the balance sheet. Cannot flow through retained earnings. Why do we have this separate equity section on the balance sheet for unrealized gains or losses on long-term investments? What it means is that whatever investment value changes gave rise to these fluctuations, up or down, in unrealized fair value, if being held longer from the year, there's a better chance of continuing fluctuations in those fair values. So that new line on the balance sheet acts as a buffer, protecting the income statement results from jumping around until the investment is finally sold. So if we have wild fluctuations in the value of long-term investments, they won't affect our income statement until they are sold.